Welcome back, Accounting Boffins. You're with Ashraf Patel. We're doing income statement, also known as the statement of comprehensive income. We're relating it to our adjustments. Right, let's get right into it and see what do we have here. Right, we have information relating to global trading, right? And we know that we're completing the adjustments, so here we go. That's an extract of my pre-adjustment trial balance. Remember, this would be obviously my balance sheet account section, and this would be my nominal account section. So clearly you can see that when I'm doing my statement of comprehensive income, I need my nominal account section. Obviously, there may be information in the balance sheet account section as well, depending on the information. Okay, the first adjustment says, a credit note was issued on the 31st of December for 9920. Goods were sold with a markup of 60%. No entry has been made of this transaction. Right, so simply it means that there was a transaction where a debtor returned goods to us. Okay, now two things to take note of here. One, when there's a physical return of goods, as is the case in this particular transaction, then you have to do two entries. One with the selling price and the other with the cost price. However, when there's just an allowance granted to a debtor, then you only do one transaction, and that's with the allowance, which obviously would affect your debtor's control and the debtor's allowances. So keep in mind that when there's a physical return of goods, there's always two entries that we need to process. So in this case here, there was a physical return of goods. So what are we going to do? Two entries. Let's look at the two entries here. Firstly, the selling price is 9920. So obviously, what's the entry for the selling price? Will always be a debit to debtor's allowances and a credit to debtor's control. Think about it rationally. The debtor owes you less. Credit the debtor's control. Debit your debtor's allowances, which we will subtract from our sales figure. Right, but we were not given the cost price. We had to calculate the cost price. Not a problem. Don't fear when Ashraf is near. Okay, so what are we going to do? Watch. The markup is 60%. So therefore, keep this in mind. Your cost price is 100, your markup is 60, and your selling price is 160. So obviously you can see, what are we calculating? The cost price, so multiplied by 100 divided by 160. There's my calculation. And if I do that calculation, let's do the calculation. So here we go, 9920 times 100 divided by 160, and voila, we have our cost price of 6,200. Okay, so this we've now calculated the cost price of the goods that were returned. How does this impact on my statement of comprehensive income? Watch. Here's my sales figure of 3345 and my cost of sales figure of 2,090,625. Sales figure once again 3,345,000. Okay, so there we go. 3,345,000 as my starting point. Where do I get that from? From my given information. And I subtract the selling price of the goods that were returned, and obviously this will give me now a figure of 3,335,080. Watch the cost price, which I calculated. Remember, 6,200. You remember my calculation? Here it is. And what do I do with it? What's the entry for my cost price? Look at the accounting entry, which will then make sense to you. It's a debit to trading stock, the goods coming back into our business, and a credit to my cost of sales. Therefore, my operation in my bracket is critical. I'm crediting my cost of sales, meaning I'm subtracting from my cost of sales. There we go. So 2,090,625 from where? From my given information, and obviously minus the cost price of the goods that were returned to give me 2,084,425. Sales less my cost of sales will give me my gross profit of 1,250,655. That's the first part of my statement of comprehensive income, done and dusted. What is it? Sales less the cost of sales. Got it? Brilliant. Let's move on. Rent was received up to January 2021. Take note, the rent was increased by 12% on the 1st of August 2020. Right, this is when the percentage increase in rental is given to you. Let's watch how we go about doing this calculation. Very important. Once you master it, piece of cake, chocolate cake, so you know what's our favorite. Okay, here we go. My rent income figure is 126,224. Remember, that figure includes January, which I now need to remove, okay? But the rental was not constant throughout the year. There was a change in my rental, as a result of which I now do the following calculation. Here goes. Let your old rental be 100%, right? Your new rental will be 112. Why 112? 100 plus the 12% increase. Now ascertain, for how many months was the rental at the old rental? Remember, the rental only increased. When did the rent increase? Let's just check this out. The rent was received up to January. The rent was increased in August. So obviously, it means that from January to July, which is 7 months, your rental, therefore the 7 guys, times the 100%, which was the old rental, to give me a figure of 700, right? That's the old rental. Let's take the new into consideration. The new was for 6 months. Why 6 months? Watch, August, September, October, November, December, and January. Why am I including January? Because I've received the rental including January, and that's the challenge. I need to determine the January rental to be able to do my adjustment. Therefore, watch this here. It's 6 times 112 to give you 672. Now watch what I do. 700 plus 672. Add the 2 percentages, and that will then give you the 1372. Now you know where the 1372 comes from. It's the total in terms of the old plus the new. Got it? Okay, now what do? I now drop my equation. What's my equation? 1372 is equal to 126,224. From where? From the rent income figure given to me in my pre-adjustment trial balance. And what am I looking for? Always ask yourself, what am I looking for? I'm looking for the January rental. Now, what was the January rental? The January rental, was it 100? Definitely not. What was it? It was the 112 because it was part of the new, the increased rental. Okay? Therefore, 112 is equal to my unknown. Cross multiply. Let's do that. We say 1372. Let's take it the other way. Let's say 126,224 times, remember, cross multiply. So let's go back to our calculator. 126,224 times the, let's go back there. Here we go. 126,224 times the 112 divided by 1372, and here we go. There's my figure, 10,304. What is the 10,304? That will be the rental for January. Now you ask the next question. Was this an accrued income or a deferred income? Remember, deferred income, also known as income received in advance. Clearly, this was a deferred income. Operation tells me minus. Why? It's a debit to rent income and a credit to deferred income. Remember, deferred income will go to your balance sheet under trade and other payables because it's a temporary liability. So therefore, watch my operation. Here we go. 126,224 given figure minus, that's the important operation. Minus, why? Debit the rent income. Let me just explain this a little bit further for you. Here's my rent income. right? It's an income account with a credit of 126,224. Watch, I'm subtracting, meaning I'm debiting rent income with 10,304, and therefore this, in accounting, when you do on the opposite side, you are actually subtracting. Therefore, 126,224 minus the 10,304 will give me my rent income figure that I need for my statement of comprehensive income. Got it? Okay, next adjustment. Consumable goods used during the year amounts to 54,368. Remember this acronym here? RTFQ. Read the full question. Right. Why? Because they're clearly telling you in this adjustment, your consumable goods used, not what was left over. And therefore, the adjustment changes. So therefore, this is what we do. If that's the amount that we used, clearly you can see here, here's your consumable goods that you bought, 62,540, but the amount that you used, the moment that figure is given to you, that becomes the final figure for your income statement. Obviously, the difference between what you had purchased, which was, where's the figure, 62,540, the 62,540 minus the 54,368. Let's get that figure here. Here we go, 62,540 minus 54,368. Obviously, the 8172. What is the 8172? That is your consumable stores on hand left over. That will go to your balance sheet under inventories. Okay, next one. Bad debts, a further amount of 8,360 must be written off. The provision for bad debts must be adjusted to 10,480. Okay, what does this mean? Firstly, do the bad debts. Double entry, debit bad debts, credit debtors control. Let's do that. So there's my bad debts figure, 9450. Here you can see there's my 9450 plus the further bad debt of 836 gives me 8360 gives me a total of 17,810. So my bad debts is 17,810. Remember, we said good practice, but because we've done it here, we're just saying that take that amount there and show it in your brackets as part of your calculation. Okay, now we come to the provision for bad debts, which said must be adjusted to 10,480. Before we continue, what type of an account is provision for bad debts? Provision for bad debts is what we refer to as a negative asset. Why? It reduces the value of my asset. Which asset? Debtors control. Therefore, in my balance sheet, we say debtors control less provision for bad debts. And this then tells you your net trade debtors. Okay, so in terms of the provision, I currently have a provision of 13,050. So therefore, I know now that I must reduce that provision by 2,570. Why? 13,050 minus my new provision of 10,480. And here you can see it, provision for bad debts, because it is being reduced, indicates that it will appear under my operating income. Keep that in mind. When you're increasing your provision, it's an expense. When you're decreasing your provision, it's an income. As you can clearly see, we decreased our provision, and therefore it is now an income. The adjustment is an income of 2,570. Okay, next adjustment. Interest on the fixed deposit was earned at 8% per year. Take into account that the fixed deposit was increased by 30,000 on the 1st of September. This transaction was recorded. Okay, here we go. So there's my fixed deposit. Let me identify it. Where it is, there's it, 55,000. So therefore, when I'm doing my calculation, remember, 55,000 is the new amount minus the amount that we increased it during the year to give me my old of 25,000. So therefore, if we work out our interest on the initial investment, It's your 25,000 times the 8 divided by 100 times 12 divided by 12. That's for the whole year. The interest earned on the new investment will be 30,000 times the 8%, which is 8 over 100, 8 divided by 100 times 4, because it was only for 4 months, to give me a total of 800 Rand. So your total interest should be 2,800. Watch what you do here. Separate the old from the new. Find your initial fixed deposit, work it out for the year. Then work out your fixed deposit on the new investment, add the two together to give you your total interest that you require. Therefore, look at my interest income. If I look at the figure that I'm given here, interest on fixed deposit is the 2,200. So remember, this total amount that you require here is the 2,800. So that was my calculation of my interest. The 2,200 was the figure given to me, plus 600 will give me my 2,800. Okay, the last one that we have here, last one that is just before the break. Let's just go through it very quickly. We are told here that insurance included a policy with a yearly premium of 9,900. It was paid on the 1st of August 2020 and expires in July. How do we deal with it? Firstly, find your insurance figure of 26,500. Here we go. But remember, this is one policy that we must remove. We're working with a one policy that has a prepayment in it. Therefore, you find that the total amount that we paid was 9,900. It was paid on the 1st of August. How many months were for the next financial year? 7 months. So what do? We take the 9,900, divide it by 12, and then multiply it by 7, and the 5,775 will be the amount that we've prepaid on the insurance. Therefore, this is what we're going to do. Watch. There's my insurance figure, 26,500. From where? From my given information, 26,500. There we go. Minus the prepayment. Why? Because what's my double entry? My double entry is a debit to prepaid expenses and a credit to insurance. Once again, look at your insurance account to make it much more clearer for you. There's your insurance with 26,500, right? Remove the 5,775 to give you a figure of 2725. What's my double entry? Debit prepaid expenses with 5,775 and a credit to insurance, indicating that you must subtract in the brackets. Okay, guys? That's as far as it goes in terms of your calculations. Remember, we're doing more adjustments. You want to know more? Stay with us. See you in a jiffy.